Hi, this is David McIndoe. I'm a partner at Sutherland. Thank you for joining today's webinar entitled Alternative Investments, Opportunities in Energy Investing. Just a little bit of a format note. We have elected to have the question and answers be through a web platform, so please submit any questions that you might have through the web and we will address them at the end of the presentation. The topic of alternative investments in energy is a timely one, and we have designed this panel to provide you with several different perspectives on the subject. First, I'd like to just give a few quick thanks. First to my fellow panelists, Marietta Moshiashvili from TIAA-CREF, Frank Conley from Freepoint Commodities, and my fellow partner, Tom Warren. I also got a lot of support from several of my partners, including Cynthia Shaw from the insurance team, Brian Barrett from business practices, Jamie Kane from business practices, and Ben Clark from the energy team. The idea for this panel came from a couple of conversations. The first was a conversation that we had with some folks from Freepoint about various deals that they were looking at, and Frank will talk about that later in the panel. The second one came through some of our discussions with our colleagues between Sutherland's insurance practice and our energy practice. As many of you may know, we are quite active in the insurance area as well as energy, and we've also been dealing with other institutional investors in private equity and government plans. For those of you who don't know me, I'm a partner in the energy practice. We have about 50 lawyers in our group, and we have offices in New York, Houston, Austin, Atlanta, D.C., London, and Geneva. Our group covers all aspects of energy, including regulatory, transaction, and litigation matters. And we cover almost every energy sector. That would be like oil and gas and electricity. Some of our project lawyers and trading lawyers found that a lot of our deals we're starting to deal with insurance companies in particular, but other forms of institutional investors as well in their formation and structure. We've noticed that this corresponded to a change in the capital markets, and we thought, well, there seems to be some activity here, and we reached across to our colleagues on the insurance team and started having this dialogue about what are developing trends for both insurance companies, but also for those of us in the energy space. And these two conversations were the genesis of this presentation. So the way we're going to lay today's out is I'm going to talk a little bit about the details of that conversation, and then I'm going to ask Marietta to talk about the experiences of TIAA-CREF, and then I'll ask Frank to talk a little bit about what Freepoint has seen in terms of investments by institutional investors in energy. And then my colleague Tom will bring in some points that we've seen as both counsel to insurance companies and as counsel to energy companies. And then at the end, we will do the question and answers. And as we're going along, if you do have questions, please feel free to submit them over the web. And again, we'll address that in the end. All right. As many of you know, institutional investors, including insurance companies and government plans and other form of alternative investments, have a history of investing in a category referred to as alternative investments. And these would be investments in things like agriculture, soft, metals, and in particular to this presentation, energy. And it's not limited to one mode of investment. We know that people make direct investments, but they also invest in funds, and we also invest in other forms of participation. In fact, what got me particularly involved were structuring derivatives that might be available for insurance companies to invest in various transactions. Energy has always been one of the key focus areas for institutional investors when making alternative investments. Some of that has to do with that they can be capital-intensive projects, and they really require folks that can put a large amount of money to work although many of the projects that we've been working on have been focused on looking at smaller pools of money and how we can put those to work. There's also attractive tax aspects to many of the transactions. But as I mentioned at the top of the presentation, what really started the genesis of this presentation was that we were starting to see changes in the energy market, both in the financial market and the physical market for energy commodities. And we were watching them make changes in how deals were structured, to whom that they were sold, and ultimately the forms of financing. A lot of this was driven by the participation of investment banks. There's been a lot of media attention, which many of you are aware of, with several large Wall Street players exiting the commodity business. Most recently, you saw J.P. Morgan Chase being sold to Mercuria, and recently we saw that TransMontaigne was sold to a third party. What's driving some of this has been well known. A lot of it has to do with regulatory change. The Volcker Rule obviously receiving a lot of attention, but we've also seen concerns under the Dodd-Frank Act, particularly to the extent that commodity platforms were offering derivatives products, and that activity potentially leading to swap dealer registration and prudential oversight. And then we've also seen concern by the fact that the CFTC itself, under the Dodd-Frank Act, has new regulatory enforcement powers, and with some activities at FERC have been quite interested in bringing large dollar cases to the market. In addition, it's been a relatively stable period for some commodities in terms of volatility, reducing the opportunity for people to make proprietary investments. I think the other thing that really has triggered a lot of this concern for financial institution are some of the higher severe loss events, and particularly rail transportation disasters. Where we saw this come up was discussions of bank capital and how that gets employed, and a lot of concern expressed by regulators about the ability for a financial institution to absorb what could be a high severity loss due to something like a rail car disaster. So what we started thinking and seeing is that this is an opportunity for other sources of capital to start coming into the market. Now, as I said at the top of the presentation, a lot of institutional investors are already active market participants for making direct and indirect investments in the energy sector. But at this point in time, we think that there are new opportunities for institutional investors to make big plays in the market, hence the genesis of this presentation. With this, I'm going to ask Marietta to talk with us a little bit about what TIAA-CREF has been doing in the alternative investment space. We put up a few topics here on our slide, but Marietta, if you would, please tell us a little bit about what TIAA-CREF has been doing.
Thank you very much. Maybe I'll provide a very short overview of TIAA-CREF as an organization. We're one of the Fortune 100 companies providing financial solutions to almost 4 million participants. We've been doing it for more than 90 years, and we service 15,000 institutions in the U.S. Institution that I represent has been active in both energy and infrastructure sectors for over 20 years, based primarily initially on the fixed income experience. However, we started to invest directly into projects associated with infrastructure strategy and energy strategy since 2008. And currently, our infrastructure and energy portfolio amounts to over $3.3 billion. It's comprised of equity-related securities, high-yield debt, and convertible debt. We have a global footprint in the U.S., stronger parts of Europe and Australia. We have diversification by asset type as well that encompasses toll roads, utilities, transmission lines, pipelines, oil and gas reserves, and renewable assets. In respect to the opportunities and how we look at various markets, as it comes to energy strategy, TIAA aims to have exposure to assets that provide us with exposure to commodity prices. We feel that that's a hedge for the inflation over the long term. We are a financial investor and typically seek partnerships with strategic players in the industry that have ability to operate the assets on our behalf and aligned with us in operating of those assets. We also have a team of 16 experienced professionals with more than 200 years of professional experience. We have a geologist on staff and an engineer that also helps us evaluate multiple opportunities. So when we invest in assets, we look for alignment, we look for prudency of operations. For infrastructure strategy, we're looking for a stable, consistent income return. For energy strategy, we're looking to capitalize on long-term growth from worldwide energy demands through exposure to some of these energy-related assets and commodities. If you were to think about us from the opportunistic approach, we have been able to also design innovative structures in partnership with various players in the industry where we have platforms in the transmission subsector, in the renewable subsector. We're developing one currently in the landfill gas, and of course oil and gas reserves. Back to you.
Yeah, thanks, Marietta. You know, one of the things that your comments generate is that this is comports with what we're experiencing from the transaction side, is that insurance companies and other institutional investors are bringing a lot of know-how to the table. And you mentioned the geologist. I think that that's consistent with what we're seeing in terms of when we are working on projects, insurance companies in particular, with the deals that Tom will talk about a little later, they're bringing assets and know-how to the table that go far beyond just the traditional analytics that you might look at in an investment. Marietta, we'll save a couple of questions we have about TIAA-CREF and its investment for later on in the panel. But Frank and Tom, anything that her comments may have generated beyond that? All right. We're going to turn it over to Frank right now, and Frank has a presentation to roll through that talks a little bit about what Freepoint has been doing from more of the sponsor side. So Frank, it's with you right now, and feel free to advance the slides.
Sure. Thanks, Tom. And just a little bit about my background. I was in the private placement business in investment banking for close to 15 years, working originally at Merrill Lynch, then Deutsche Bank, and most recently at UBS, where I specialized in selling structured deals to U.S. life cos primarily, and was hired by Freepoint about a year ago to help them fund the various deals that they originate through their trading activities and also their merchant bank. And what I'm seeing for investors is, I think, a great opportunity to enhance yield by investing in physical commodity-related transactions. And I'll give some examples in a few moments. But first, I just want to give a little bit of a highlight what Freepoint is. In a nutshell, Freepoint is the reincarnation of Sempra Energy Trading, which was one of the world's largest commodity trading shops up till about 1998, when it was sold to RBS Sempra. So it was a group that was founded in the 80s by a gentleman named David Messer, Frank Galipoli, Rob Feilbogen, and others. And it's the former Drexel Burnham, which became AIG, which became Sempra Trading Team. And they built it from scratch into a multi-billion-dollar trading shop, and in 1998, it was sold to RBS Sempra at a very inopportune time. And shortly after the sale, the principals of Sempra Energy retired and decided to go fishing for a couple of years. But what happened since is in 2011, they decided to basically bring back the band together and all the employees of Sempra have basically rejoined in the same building in Stamford, Connecticut, and are back in business trading physical commodities. The key difference is in 2008 and prior, we were owned by a regulated utility, the San Diego utility, and had very inexpensive access to capital through the utility. Now we're private equity funded. And we've got a slide in this presentation which basically shows that we're funded by Stone Point Commodities. We've got about a $300 million capital base from Stone Point, as well as $100 million invested by employees. So that's just a bit of background about who we are. But the core business is merchant trading, so physical trading of a number of different commodities, including oil, gas, power. And we're also very involved in merchant finance, which is basically structured finance on behalf of physical commodity owners and developers. We get involved, arrange financings, and ultimately lay off the risk to the insurance market with folks like yourselves. But the global footprint of Freepoint, we're based in Stamford, Connecticut, with offices in Houston, London, and Switzerland are our main offices, with a number of satellite offices around the globe, including Singapore and China. In terms of the commodities we trade natural gas, power. We've got a very deep crude oil trading activity, refined products. We have got a coal trading desk. We've got a very active metals trading desk, which is focusing primarily on trading copper concentrates and gold. And we also have shipping. We are in the process of buying a number of ships to move freight around the globe. And that's another investment opportunity that we could bring to the market. But in terms of merchant finance, the basic business that I sit in is basically the marriage of the expertise between the physical trading and financing, where we take the origination capabilities mostly through our trading and also long-term relationships that we have through our days at Sempra, and our market knowledge and our ability to hedge commodity risk and put together structured financings. And I'll give a few examples. But what Freepoint brings to the table is really the ability to structure deals and mitigate commodity risk, yet still provide investors with enhanced returns relative to most other deals that are currently in the market. In terms of recently closed transactions, my slide is not coming up at the moment, so I'll have to read from a piece of paper here. But we closed a gold mine financing in Brazil back in late 2012, where we took a controlling interest in a gold mine in Brazil and have 100% of the offtake. We also have been very active in natural gas, and in 2013 we bought 66 natural gas wells, and again have all of the offtake from those wells, and those are located in Wyoming. We executed a coal prepay, which is a form of financing where we prepaid for all the production from a Kentucky coal mine. And as you can imagine, a lot of the coal miners are in need of capital at the moment, so we're very active with coal miners. One of our larger deals last year is we bought as a principal investment the second largest fixed leg oil production platform in the Gulf of Mexico called Whistler. And it's a platform that when we bought it from ExxonMobil was only producing 1,000 barrels per day of oil, and we're now up to about 3,000, so we've tripled production. It has an EBITDA of about $45 million, and we put on debt, mostly with private equity and BDCs. But it's a kind of debt which we think once this production platform becomes a little bit more stabilized and has a long earnings history, we could bring to the insurance market once we get that rated. And the one deal last year that I sold to the insurance market was a VPP, where we Freepoint purchased an overriding royalty interest in 1,000 oil wells in the San Juan Basin, which is New Mexico, Colorado, and this is a very stable producing area. And basically we securitized the flows of oil from these diverse set of wells, ran the sales through an SPV and through a long-term hedge with BP. We converted the future flows of oil production into fixed cash flows. We got the deal rated by Kroll Bond Rating, and it was a BB rating, which translated into an NAIC 3 rating. And we sold 10-year notes with a coupon of close to 8%. to two very large U.S. life insurance companies. So that's an example of a very attractively priced commodity-linked transaction. Now, in terms of key themes and what we see investors are looking for, we are seeing now with the yield environment the way it is, meaning very tightly pricing price deals, that there is more of an appetite in the insurance market for taking higher risk, more risk. So we're seeing more demand for double B deals, but I will say that the demand in the insurance market for double B is still a lot less than what we see with BDCs and other institutional investors. But we are seeing an opening up for double B transactions. We're also seeing a very healthy appetite for project financings, and we're currently involved in looking at a number of LNG, small-scale LNG-related projects, as well as more VPPs to come. And we're also seeing that investors, to get the yield they're looking for, are willing to look at some emerging market countries in South America and also in Eastern Europe in particular. But in terms of significant developments that Freepoint sees, what we're seeing in the market, which is really driving our business, is, and this is something that Tom alluded to earlier, is there is a very large exodus in the commercial bank market from the physical commodity business, and we know that Barclays, Deutsche Bank, JP Morgan, and countless others, for regulatory reasons, can no longer be in the physical commodity business. So on a daily basis, we're being approached by metals producers, by refiners in particular, looking for alternative capital, and they're willing to pay up to get their deals financed going forward. So we see a tremendous opportunity for the institutional market to replace the bank funding that's been a staple of the commodity space for many, many years. The other thing that's really driving the business for investors and for us is the tremendous amount of capex in North America related to the shale plays, the various shale plays. And the latest flavor of the month or the year is what's happening in the Permian Basin, which is really the next Bakken, if you will, where there's a tremendous amount of focus in capex, where we have the oil field operators, the developers, and also, again, on the LNG side, we're seeing a number of LNG developers coming in and taking some of the nat gas that would otherwise be flared in that part of the U.S. and basically converting it to small-scale LNG and delivering the LNG to the operators and other parties in the Permian Basin as a replacement for diesel fuel. So we're going to see a number of these small-scale LNG deals come into the market in the coming 1 to 2 years, and we're involved in one in particular. Also, on the mining side, we are seeing a great deal of demand for the development of copper mines in the U.S., and we're talking about Arizona, New Mexico, Nevada. And the issue with those is you've got some pretty strong sponsors, but there is about a 2 to 3 year development phase. And for those investors that are willing to spend the time to fund a development project, we think the returns could be very attractive. So in terms of the kind of transactions that Freepoint is looking to execute this year, which we hope could have some connectivity with the market, is, again, VPPs, which we'll bring 1 or 2 this year. And it's really for those investors who are comfortable taking a bit of production risk to take proven commodity out of the ground, mainly oil, but sometimes a combination of oil and gas. And it's comfortable with facing a counterparty. We will hedge the commodity price on all these deals, but it does require that we are comfortable, or you would be comfortable, facing someone like BP or another hedge counterparty to hedge out the commodity risk. But we think those are very attractive transactions, and in the history of VPPs, if you go back 15 or 20 years, we don't know of any that's gone into default. They've all gone very, very well. We are seeing a very strong need right now for commodity repo funding. Companies like refineries that have a certain amount of commodity, or utilities that have coal on their sites, who would like to typically access the bank market to take that asset under a repo and then sell it back to them on a future date. The banks no longer can take that physical title, and we've been offered opportunities for Freepoint to step in and buy, for example, a pile of coal with a utility and sell it back to them several months or even in some cases a couple years from now. And if we can find investors willing to team up with Freepoint to fund that purchase and resale, we think we could show them a lot of deals, and I think very, very nicely priced deals for the risk they're taking. And finally, I just want to end on sort of some of the challenges we've seen. You know, we see a lot of opportunities certainly in dealing with investors on the insurance side, but we also see challenges and issues that come up which make commodity deals sometimes a non-starter for many folks, and we're hoping to be able through education to overcome some of these reservations. But you know, the first is, you know, comfort with highly structured transactions. And on a VPP, for example, if someone has not seen a VPP before, we often see a reluctance to roll up their sleeves and spend the time to learn about the ins and outs and the structures. So to get to these kind of returns, we would just need an investor to be able to spend time to get comfortable with new structures. Also, comfort with commodity price risk. If we're not putting on a hedge, which is sometimes the case, being comfortable and being able to manage and take a view on certain commodity price swings. And if hedged, then being able to face a counterparty. And when you put on a hedge on a structured financing, on a structured note, the issue that some investors have is the claim the hedge counterparty has under the swap is pari passu with claims that a senior lender would have. And that's similar to a cross-currency swap, but that becomes an issue in some transactions. Another issue that some investors have with a number of commodity deals is they're often structured where you're monetizing a flow of commodity sales. And there isn't necessarily a fixed maturity date. There's an expected maturity date, but it's not fixed. And there could be some situations where the maturity is extended by a year or two on a 10-year deal, for example, which for some insurance companies that really need to micromanage the duration of their investments, that becomes an issue. So we're hopeful that investors become less focused on this type of extension risk and can take a little bit of extension on their investments. Another issue that we would like to be able to solve now that the banks are pulling out is the ability to find pockets of money who can fund short-term and compete with the bank markets. And just going back to the repo example, we're seeing a lot of 1 to 3 year terms, 3-year deals that are priced just sort of a LIBOR 350 with BBB or single A rated counterparties. And I think the return is quite good. The issue for some investors is just maturity. Once you go inside of 3 years for many insurance companies, the interest really does fall off a cliff. So we'd love to be able to develop a capital pool that can fund short term. And finally, we're always looking for investors who can take a bit of development risk on projects and also on oil fields to basically help producers develop a program and ultimately wait a bit for the production to come online, again, at very attractive returns. So those are the themes that we're seeing, some of the opportunities and some of the risks and challenges. And I know I've covered quite a bit of ground in a short period of time, but just wanted to cover those key areas, and I'll hand it back to Tom to go from here.
Okay, great. Tom, I'm going to advance the next slide.
Sure, and before we do that, I just thought one thing I thought of, Frank, as you were going through kind of a question for you and for Marietta. You covered a range of different types of investments in the energy sector, and one thing that we've seen a fair bit lately, fueled by the unconventional oil and gas shale plays, is increasing interest in petrochemical facilities like ammonia, urea, ethylene, propylene, and we've been doing a fair bit on that side, and wondering if to both you and Marietta, if you guys are seeing anything in that area.
Well, at Freepoint, we're not really involved in the chemical space. I mean, we're showing those types of deals quite often, but since it's not a commodity that we trade, we tend to stay clear of those, at least for now. So that's not an asset class that at this point we're getting involved in. But there are some quality deals out there, but they're just not for us.
Yeah, I would concur in terms of this is not an active strategy for us as well, but we've absolutely seen an increase in deal flow. And in general, I guess if you were to comment on some of the strategies that have been already mentioned by Frank and how different they are for us, we are trying to get exposure to the commodities through direct ownership of companies that have reserves underground. So it's a bit of a different strategy where we're either actively managing them through control, or we have partnership with operators and strategic players where we have an alignment of interest in terms of how we would manage and mitigate the volatility of the commodity pricing associated with those plays. In respect to the market, we've definitely seen a consolidation of major plays, shale plays in the U.S. We've seen a lot more activity, as was already mentioned, in Permian. Obviously, Bakken, Utica, Niobrara, and Marcellus. We've seen a bit of a withdrawal from Eagle Ford. And we've also seen that the midstream plays, well, they've been very attractive before 2011, I want to say, 2012. They're becoming less attractive in terms of the engagement at this point. And having said that, we see a flux of activity in the midstream sector around the shale plays, and a lot of new funds and management teams, frankly, popping up to meet a large influx of capital into the energy space. However, we've also noticed a need to differentiate on the quality of these particular deals, and we've seen a difference even from 6 months ago to now as to whether the acreage that we're seeing right now is a Tier 2 or Tier 3 versus Tier 1 for areas that we've seen a few months back. So just wanted to make sure I provide a bit of a detail on our strategy in energy in particular. And, of course, we also have a very active renewable strategy. But on chemicals, I agree, we're not as actively pursuing them for now.
All right, so this is Tom, and I'm going to talk a little bit about some of the deals that we've done. Now, our team we have a broad-based energy team. My primary practice is in power, including renewables and gas. So that's what I'm going to focus on. But our team we have over 50 energy lawyers in New York, Houston, Austin, D.C., Atlanta, London, and Geneva, and we practice across all practice areas and all parts of the industry. So if there's things that I don't cover, we have other lawyers who cover those areas. So following on what Marietta and Frank had to say, we're seeing the same thing in institutional investors looking for higher risk, higher return investments. And to that end, I think a lot of people have come to us when they say, what are you seeing? Do you see any of the power side, for example? Do you see any operating assets with a long-term PPA with a utility? And that seems to be what everybody wants. And so, in order to find those deals, and when those portfolios and assets come on the market, you're really bidding for, against cost of capital there, because there's very little energy-specific risk in those deals. So what we've started to see is people looking for ways to take more inherent risk, but find ways structurally to de-risk those projects, and then also to understand the risk to make sure that you're not taking any risk that you don't understand that you're taking, and thereby gain a competitive advantage by better understanding those risks. So, for example, one structure that we see on the direct investing side in renewables is people pushing forward, going further away from from commercial projects and taking some risk, either construction risk or development and construction risk. And that way they're able to take a little bit of a riskier asset and get a higher return. So some of the ways that we've helped people to de-risk that are, for example, working with them on negotiating not only acquiring those projects with a direct investment, but also working with the EPC contractor or the turbine supply agreement, the turbine supplier, to make sure that, for example, the risk of the production tax credit is covered off. Now, ultimately, the investor will take the production tax credit risk at some level, but making sure that structurally it's set up so that you have strong assurances that all those requirements are going to be met. Similarly, even on renewable projects, we encounter very significant environmental issues, and the investors are having, as I think Marietta said, have people on staff. We are seeing people either having on staff or hiring environmental consultants and having people who can do serious environmental due diligence to make sure that that's not an issue. We've also seen people, institutional investors, having essentially, an ex-plant manager, that kind of person on their staff who can do significant operational due diligence to make sure that on an operational level you're comfortable with the assets, both spinning and pre-commercial, to make sure that you're really doing serious due diligence to minimize the risks. And again, to be able to take a riskier asset but get comfortable with it by virtue of doing your due diligence and by using the legal structures to minimize the risk. A particular risk that we see on the renewable side, and Frank mentioned this, we've seen this on both sides. We often will do these deals both on the commodity side and on the investor side. If you have, for example, a wind project and you don't have a long-term PPA, but instead you have a financial hedge instead, you need to be really careful on basis risk, because the hedge providers will want the pricing to be at a hub to eliminate some of the commodity volatility. But if you're investing in the asset itself and you have the protection of that hedge, you need to recognize, for example, that you have a distinction between the nodal price that you're going to sell into the market at and your hub price at the hedge. Similarly, again alluding to what Frank was mentioning, you've got to really understand your security package if you have a lien secured hedge as your security on a hedge, and you're taking over an ownership position, an equity position in that asset. You need to look very carefully at your security package that you're going to be granting there. Another issue that we've seen come up, particularly for institutional investors, is due to essentially the typical size of a lot of energy investments and the appetite that the institutional investors are having for exposure to a particular investment. Is you're seeing the insurance company or institutional investor taking on a minority position or partnering with either a strategic player or another financial investor in taking their positions. And when do that, we are helping them to make sure that they have enough minority owner protection, both sort of the standard protection that you would have for any investment as a minority owner, but also things particular to the energy sector relating to operational assets. By way of anecdote, one thing that's come up, and this is more of a shorter term than a longer term issue, but one thing that has come up frequently lately is pre-closing to closing risk regarding operations of the asset. We've seen several instances where you've had significant issues happen between the signing of a deal and a closing deal, and making sure you properly allocated risk between the seller and the buyer in an investment of that risk. And that's become a significant issue in a number of transactions we've worked on lately. So that's, as much due diligence as you can do. You can't anticipate those events, but you can structure your deal accordingly to protect yourself. Moving on, I want to talk about a few recent legal developments. There's been a fair amount going on in terms of legal developments in the power and gas area. So I want to talk about a few recent developments that you've probably seen in the news or at least heard of. And each one of these things could probably take on a 1-hour webinar, but I'd like to just touch on a few of them. One is, as you probably have all seen, is the EPA's proposed rules on carbon that came out on June 2nd. This is a very significant proposed rule. You've probably read articles of all kinds on it. But a few things about this rule to go into, because there are some details that I think are relevant that not everybody is familiar with. For one, so this is a proposed rule at this point under the Clean Air Act, and they expect to finalize the rule in about a year's time. And it's a rate-based carbon emissions target right now for existing sources. So it's based essentially on carbon intensity as opposed to absolute numbers of tons of carbon emitted. There's significant variation by state, and it was done based on the EPA's assessment of the state's ability to reduce emissions based on 4 different factors that they took into account. It's both efficiency of plants, redispatch of coal to gas, replacement with renewables and nuclear, and demand-side efficiency. The EPA is given a lot of flexibility to the states to implement plans, including potentially multi-state plans. And the EPA was aware of existing programs like RGGI and AB 32, and of course state RPSs. And according to the rules, they are trying not to interfere with that. Now, exactly how that's going to work is another question. So what's going to happen here is, over the next year, we're going to see a final rule, and there's a comment period ongoing now, and then there'll be a final rule in June 2015. And as it's stated now, by June 2016, the states will have to provide their plans. There are some ways in which that can get delayed another 2 years, and then the EPA will have up to 12 months to review that. So we're looking pretty far out at when we'll finally know. But the gauntlet has been thrown down here, and what's really the relevant now is that risk is clear and present now. A few takeaways from this. One is, it is unclear as of right now who will be the regulated entities. There seems to be a base assumption that it would be the generators, but it's clear in the rules that there is flexibility among the states to impose it on load-serving entities or others that can result in carbon emission reductions. So thinking about that going forward, if you want to enter into a long-term hedge, or you're going to acquire or make an investment in an asset that has a long-term power purchase agreement or a hedge, you're going to need to look carefully at how that's going to handle various potential for the change this law will bring. There could be a requirement for the facility owner to have allowances. There could be allocations of those allowances. There could be new sources of revenue coming from plants, depending on how the rule is implemented. So there's a lot of factors that could go either way that have to be considered now that this rule is out there. And of course, we know that there's some novel concepts in this rule. The provision in the Clean Air Act under which this is introduced really governs the sources, and there's ways in which this looks outside the fence, so to speak. There will certainly be challenges to this rule, and in the course of those challenges, and there's also possible opportunity for a legislative override here. The legislature could decide that this, a patchwork of 50 different rules will actually be worse than some new legislative fix. So there's a lot of uncertainty here now that needs to be taken into account today when making investments in these assets. A second one I want to talk about is we're expecting later this month or possibly early July some IRS guidance on the start of construction test for renewable projects. By way of quick background, to qualify for the production tax credit for wind projects, you had to have started construction by the end of 2013. There was both a safe harbor and a significant physical construction test that you can satisfy. Now, at the end of last year and early this year, we've got lots of projects that have been financed based on the safe harbor, but projects are having a great deal of trouble getting financing when when they're relying on the significant construction test. In particular, tax equity investors, some of those on the line are in the group of tax equity investors, but tax equity investors, as a general rule, will not take the risk that there's not going to be a PTC, and so as a result, there's been a real trouble of getting financing due to the lack of clarity in the rules over physical construction. As the rules are currently written, the bar appears very low. It appears that very small amounts of physical construction will satisfy. But regardless of that, as I've said, people in the commercial marketplace and we as a law firm are advising people not to go too low and to try to be very conservative on this because in fact the commercial investors are very hesitant on this point. So the IRS has said it will issue some guidance on this by the end of this month or early next month. And we do expect that once that guidance is out, it should open up a lot of projects that are having trouble getting financing will be real projects again. And so there should be a lot of activity following on this IRS guidance. The other thing to mention real quickly on the safe harbor side of things is that there's really an open question if you've purchased a large amount of equipment, and there's a number of developers who have purchased a lot of equipment, quote, safe harbor equipment. If you have that equipment, so you've made that investment, but then you put it in a project that you did not own at the end of 2013, will that qualify? And we're hoping to get guidance from the IRS on that question as well. And if the guidance is positive on that, that will open up a whole additional group of projects that should be able to go forward and attract investment. The last legal development I want to talk about here is the export queue for liquefied natural gas. And again, by quick way of background, the DOE has to authorize exports of natural gas, and there's been a queue for licenses to export gas to non-free trade agreement countries, which is where the money is, so to speak, for most LNG exports. The DOE has had a policy where they've issued conditional approvals based on a queue that they've established based on essentially the priority of applying, and they've conditioned them on getting through the NEPA process with FERC or, as appropriate, for maritime, the MARAD. And so they've conditioned it on having the NEPA approval. So the proposal that has just been issued, and comments are due on it on July 21st, is to eliminate that queue altogether and not consider applications until the NEPA process has been completed. Generally, this proposal has been well received, and I think most people expect that the rule will be adopted largely in the form it's been proposed, but it's in the comment period right now. And the effect of this will be that it will favor projects that have enough financing to get through the NEPA process or that have started the NEPA process early. The NEPA process is a multi-million-dollar process to get through in terms of both legal fees and other fees and expenses. And some projects that were having commercial trouble or financing trouble have tried to put that off. But the projects that have gone forward with that will now advance and be more likely to be approved. A quick note on the whole globally on that, which is the DOE had commissioned a study that had not approved, I should say, but had analyzed the effects on the market of exports. And they had done the study up to about 12 BCF a day, and at that point had determined that there wouldn't be significant adverse effects, but they hadn't studied it beyond that. And so some people have thought that that would serve as essentially a soft cap on the non-FTA export licenses that DOE would issue because they hadn't studied it beyond that. We're starting to get close to that cap if you look at all the conditional approvals that have been issued. But now that this new rule is being proposed, essentially you're in some ways starting over now. Those conditional approvals are still going to be out there, and it's unclear how much, if any, additional analysis will go into those approvals. But it opens up the door that whereas you used to think, well, there's only a few more, really at this point 2 more, Oregon LNG and Cheniere are next in line, and if they got approved, we would have been up to 12. And when looking at the overall effects, we believe that up till now DOE was kind of taking into account those that had already been approved conditionally, even if those projects might never get developed. So this opens up, again, the opportunity for projects that are lower in the queue that might never have gotten there to potentially get to the front of the line. The third kind of project that this advantages would be a project that would need less stringent environmental review. There are potentially proposed compressed natural gas projects and other natural gas export projects that potentially can get through the NEPA process more quickly and therefore get approval more quickly than some processes. Whereas again, if they were down the line, they might have taken a longer time to get approved. So those are 3 developments. Again, we're happy to answer further questions on that or talk offline about those things. But those are 3 areas of pretty significant developments in the power and gas space that will affect energy investments.
I want to mention, Tom, a few of the things that we look at that are not so energy specific, but are always coming up in alternative investments. A lot of these, obviously, whenever we're dealing with a project, either from the sponsor side or the institutional investor side, we're always looking at investment limitations, and we spend a lot of time working on both sides with both client sets, trying to make sure that whatever structure we come up with will fit inside those limitations. And then occasionally we'll come up against a bump, particularly as both Marietta and Frank said, depending on what risks are being allocated to which party, sometimes those investment limitations really come up. And that's when we really, us on the energy team, need to reach across to our brethren and sisters in the insurance practice to help come inside of it. I think the other thing that we've been paying a lot of attention to this year, and it sometimes can be the tail that wags the dog, is some of the restrictions that came out of the Dodd-Frank Act, particularly as it makes the jurisdiction of the Commodities Futures Trading Commission start to invade the physical space, particularly when there's the presence of a financial hedge to make the transaction work. Some of the things that we've had to deal with a lot are commodity pool issues, whether you have a commodity trading advisor involved. But we've had a lot of questions to the extent that financial entities, which is a subset that includes things like insurance companies and various pension plans and some hedge funds and private equity vehicles, they don't qualify for some of the exemptions available for commercial end users But more importantly, sometimes it's not certain whether such entities could get classified as a commercial market participant. Why does this all matter is because a lot of the physical contracts that get associated with various project deals, there's a lot of questions that we come up with about, well, if we structure it this way, what's its treatment under the Commodities Exchange Act? So, those questions are not always particular to energy. We face them when we're looking at ag deals and soft deals and metal deals, but they keep popping them up, and they're not unique necessarily to insurance or other forms of institutional investors, and they're not unique either to the project sponsor. I think the point being, if in a bow, is any one of these investments involves so many different issues that it often takes us sitting down with clients just to walk through tick and tie. And what we're seeing is the regulatory environment really driving a lot of the commercial decisions that are being made. And that was, in part, one of the things that sparked the initial part of, or the initial thought for this presentation. We have a few questions that we have, but before we enter into the question and answer phase, I just wanted to stop and ask if Marietta or Frank had any thoughts or additional thoughts to what Tom and I just mentioned. Okay, no concern. Marietta, I have a question that came for you that has to do with what is it when a project or somebody who's advancing the project comes to you and says, look, we'd be interested in you investing in our project. What are the things that differentiate TIAA-CREF from other investors in the space? And I apologize, I'm embellishing on the question a bit.
Sure. No, thank you. I guess when you deal with us, we have differentiated ourselves by building out the direct equity platform effort in addition to the fixed income effort. So we have had, as I mentioned before, years of experience as a fixed income investor. We still have that practice. We've built a portfolio of over $5 billion in both energy and infrastructure project finance fixed income securities. However, since 2008, as I've mentioned before, we've started to shift the focus to the equity investing and more of a direct control over the entry and exit associated with those investments. We've also made a deliberate effort to have strategic collaboration between our commodity energy effort that validates the contracted nature of energy-related infrastructure. I think that's a very important aspect of our internal diligence. And the fact is that if we're looking at a road or we're looking at a power plant or renewable energy power plant, we have an in-house engineer who's able to assist us in addition to any of the external consultants that we will be hiring. And the same applies for the energy investing. We have an in-house geologist with around 30 years of experience who is able to validate some of the independent engineers' work in respect to the resources. The other thing I guess that I would say is when we try to think of particular objectives that exist with potential partners that coming to invest together in projects, we're trying to think of creative ways of establishing that partnership. We've been probably the founding member of some of the platforms that I've already mentioned because we try to listen. And as a result, while there are a few opportunities that we have to compete for, and we choose to compete for because we have a particular angle in those competitive auctions, most of our deal flow that we've closed on over the past 18 months was based on proprietary sourcing. So we do feel that because of our ability and reputation as a partner who values the input and also tries to create different structures, we have proprietary pipeline that provides us with optimal deal selection.
Hey, thank you, Marietta. The next one, hey, Frank, it's for you, and it's pretty simple. What is the ideal form for you in forms of capital for Freepoint? What would be your preference in forms of investment?
We have a lot of different types of capital depending on the deal. The easiest kind of capital for us to raise is big ticket, longer tenor transactions. But the one type of capital that we've been looking for better part of a year is a line, if you will. And I think Prudential has this concept of sort of the Pru shelf, which would allow us to invest in a number of smaller transactions that met a certain criteria. And these transactions would be, 5 to 10 million in size, effectively a warehouse type facility, which would allow us then to aggregate to a critical mass of 50 to 100 million, which we would then syndicate the portfolio of those similar assets to the market. So that type of warehouse line linked to a specific type of commodity asset class would be very, very helpful for us, and we're actively seeking it.
Okay, great. And the last question comes to me that says, what is the effect or will be the effect of the position limits rule being considered by the CFTC on these investments? The answer comes in kind of two frames. The first frame is obviously the limits themselves. Is the federal limits will now apply to energy commodities. To the extent that people are doing oil deals or gas deals, we're always looking at what's the effect on terms of limits. Now, there's very rarely a chance where any one particular project might bump up or cause somebody to bump up against the position limit, but we have a lot of questions about how do you treat any derivative instruments or option. And remember, right now, under the current proposal, trade options, which would be any commodity option that results in physical settlement, which we see a lot of, for example, in power deals, although power is not yet subject to a position limit. We're dealing with a lot of questions about how do we characterize things as hedges or when are things financing transactions. So lots of questions on just the limit. And the second frame, and we spend probably more time on this, is the aggregation concepts. What level of investment might cause certain investors to have to aggregate the positions inside perhaps a structured transaction, which leads to questions such as, where do we place the hedge? Does the hedge go inside the deal, or does it go with the sponsor? Who's the best person for the hedge? Now, there are factors beyond the position limits rule that kind of drive that decision making, but if the CFTC writes a rule on aggregation that's less favorable than they currently intend to, in other words, a rule that would cause a lot of investors to aggregate positions, that could have a very detrimental effect. It will complicate the negotiations of the documents because there'll be certain information flows and control rights that traditionally have been easily assigned. May have to go back and relook at that for position limit compliance purposes. All right. I just wanted to ask my fellow panelists if they had any other closing thoughts. Marietta, are you set?
Yes, thank you very much.
All right. And Frank?
Likewise, I'm set. And I can reiterate that I think it is a great time for the institutional market to look hard at physical commodity transactions. And Tom, and we very much appreciate the invitation to speak on this panel, and happy to answer any questions either today or in a follow-up form. Thank you.
Yeah, thank you, Tom.
Thank you so much.
No, thank you. And we don't see any further questions from the audience, so I think we'll sign off.
Thank you, and thank you, Marietta and Frank. Thank you, everyone. All right, bye-bye now.